In the constant, deafening noise of financial media, there are two numbers that dominate every headline and political debate: public debt and private debt. One is the colossal sum owed by governments, fueling arguments about deficits and national bankruptcy. The other is the quiet, decentralized mountain of debt owed by households and corporations. The mortgages, the student loans, the corporate bonds. Both represent trillions of dollars. Both are accelerating rapidly, but only one is the fuse to the next global recession. To navigate the coming financial storm, we must stop arguing about which type of debt is larger, and start analyzing which one is designed to fail in the most catastrophic, system-wide way. Today, we put these two giants head-to-head, determining the ultimate trigger of the next inevitable economic downturn. Let's start with public debt, often called sovereign debt. This is the debt of nations, managed by politicians and financed by central banks. The threat here is often perceived as louder, but the immediate crisis is generally slower. When a government reaches its debt limit, its initial responses are predictable, governed by the very unique privilege of being able to issue the currency it owes. Firstly, it can inflate its way out. As we discussed when decoding the 7 stages of national bankruptcy, the government simply prints new currency to service the old debt, effectively devaluing the obligation over time. This leads to currency crises, higher interest rates, and reduced global trust. But it rarely triggers an instantaneous economic seizure. Secondly, the solution to public debt, outside of hyperinflation, is usually political: austerity, tax hikes, or a negotiated default, as seen with Greece. The pain is distributed slowly and socially. The crisis of public debt is fundamentally a crisis of trust and currency devaluation. But now turn your focus to private debt. This is the combined leverage of consumers through mortgages and credit cards, and corporations through bonds and commercial loans. The threat here is quieter but far more volatile and interconnected. Private debt operates under one immutable law that public debt escapes. It must be repaid with real money. A household cannot print its way out of a mortgage, and a corporation cannot inflate its stock price forever to cover its bond payments. When private borrowers, saturated with Minsky's speculative and Ponzi Finance, can no longer service their debt, they default. This default creates a chain reaction that is instantaneous and systemic. When a household defaults, the bank holding the mortgage loses an asset. When a corporation defaults, the bondholder, often a pension fund, insurance company, or another bank, loses capital. This isn't just a crisis of value. It's a crisis of liquidity and counterparty risk. The distinction between the two lies in the contagion mechanism. A sovereign default, while devastating, often allows the private sector to continue functioning, perhaps with a new, devalued currency. But a private debt collapse immediately infects the entire financial system. The 2008 crisis was not triggered by U.S. government debt. It was triggered by a cascade of household debt defaults on subprime mortgages. When those mortgages failed, they collapsed the shadow banking system, froze interbank lending, and led to a sudden, immediate stop in commerce, the very definition of a recession. Today, while household debt has improved, the real danger is lodged in corporate debt. We are now seeing an unprecedented number of zombie companies, corporations whose earnings are insufficient to even cover the interest payments on their debt. They are classic examples of Ponzi Finance, surviving only by constantly rolling over their loans, assuming credit will remain cheap and plentiful. As central banks, desperate to fight inflation, have raised interest rates, that life support is being withdrawn. These zombie companies, currently supported by trillions in low-rate bonds, will be forced to default en masse when they attempt to refinance at current higher rates. This won't be a gradual decline. It will be a sudden, simultaneous wipeout of assets held across the entire spectrum of mutual funds, pensions, and insurance companies. This catastrophic loss of capital and confidence in the corporate bond market will freeze investment, stop hiring, and immediately pull the plug on economic activity, ushering in the next global recession far more abruptly than any sovereign deficit ever could. Ultimately, public debt crises are about slow, painful currency erosion, which eventually affects everyone. But private debt crises, especially those rooted in the corporate sector, are about sudden, violent liquidity shocks that freeze the engine of global capitalism in an instant. The most acute risk today is not the U.S. national debt ticker. It is the silent ticking time bomb of corporate leverage, waiting to be repriced by higher interest rates. Recognizing this distinction is vital. It allows you to anticipate where the first waves of defaults will appear not in treasury bonds, but in corporate balance sheets. If this deep dive analysis into the structure of debt helps you anticipate these systemic dangers, please take a moment to subscribe. By becoming a subscriber, you ensure you never miss the critical analysis needed to safeguard your financial future in this unpredictable debt cycle. Next time, we'll move beyond the theory and examine the fallout of one of history's most devastating private debt crises, focusing on a disaster built entirely on U.S. bank loans. The Lost Decade: How U.S. bank loans decimated an entire continent. We'll uncover how the private lending decisions of the 1970s led to a 10-year economic catastrophe across Latin America. Don't miss this essential piece of the puzzle.